All right. Wow, it got chaotic in here after that last panel. I feel like we should have a break. So anyway, thank you, ETF Global, for inviting me to moderate this panel. I don't know why they would put fixed income on after lunch. I mean, food coma plus bonds is a losing recipe. So we're going to try to keep everybody awake. Okay. Obviously, fixed income ETFs are a big deal. We're all in the industry, so I kid. This is a really important topic. Before we get into the topics, and I like the questions we're asked in the last panel, I want to open it up to you guys for questions. So about halfway through, I'll just open it up and let's just have a dialogue if we can. So before we get started with my questions, I want to get to know everybody on the panel here. So we'll go right down the line. We'll start on the end there with you, Ray.
Okay, there you go.
Gotcha.
Hi, Ray Potter. I work at Odeon Capital Securities right now. I'm not specifically in the ETF space, but I faced ETF customers, ETF rebalancings and ramp ups since inception. I'm in the emerging market space for fixed income for 35 years. I've seen the advent of this business. I've seen some of the liquidity difficulties that have taken place over time. And I think there's a heck of a lot of room for improvement. So I'm the guy in the panel that'll be more along the lines of this is the way we need to do it versus how we're doing it now.
All right, Brian Williams. I'm here with PGIM Investments. So I cover everything across multi-sector, investment grade, high yield, structured products, so really everything fixed income, both mutual funds and ETFs. So really looking forward to the dialogue today.
How you doing, everybody? Dave Sharp. I'm a director on ETF Capital Markets at Vanguard. So special thanks to Jim and Trammell and the whole team here for a great event. Looking forward to it here. We're gonna bring some thunder here, I think, Eric. Right? I mean, we're gonna try our best here. I was tasked with defending the ag at some point over the next hour, so looking forward to that.
Hello, everyone. My name is Joe Haig. I'm a client portfolio manager at Neuberger Berman. Neuberger manages over $500 billion in AUM. About half of that approximately is with fixed income. I work primarily in the U.S. intermediary space, and so similar to those here, I cover multiple vehicles, including mutual funds, ETFs, and SMAs, separately managed accounts, and I'm looking forward to it.
All right. You're in trouble when Vanguard is the one saying we shouldn't be boring. Okay, I'm kidding. No, they are vanilla. But they like it that way. Anyway, okay. I want to start with a question. This is an ETF nerd 400 level question. Fixed income ETFs have taken in about $150 billion this year. They're chugging along. What is the number one best-selling ETF this year in flows? About 3 times more than the number 2. And I'll give you a hint. It's not Vanguard, shocker. Who said that?
The guy from BlackRock. Yeah.
Oh, man. Damn. Would anybody else know that? Probably not, right? Okay. SGov is number 1 by far. This has been the year of just basically short-term treasuries. You get almost the same yield without taking on the duration risk. It's kind of a no-brainer. It's another version of cash. So let me start with you, Dave, because before we do talk about how bad the ag is, why not just buy a short-term treasury ETF like SGov, or Bill or yours, and then make that all of your bond exposure, the whole 40%. We have looked at the performance and the yield over the past 5 to 10 years. You get the same thing with less risk. So it doesn't shock me that there is a lot of money moving that direction.
Yeah, I mean, certainly, when you look at the category as a whole, SGov, you mentioned BIL having a great year for flows. VBIL, which we recently launched in February, is already at $1.5 billion. So a lot of money obviously going to that low volatility, high yield type instrument. And it's hard to blame clients for doing it, right? You look at the SEC yields on those 3 products at around 4.15% still with the rate activity that we're seeing in the market. So it's a really safe place, really low duration product to go get that. So it is a tough argument against it in many cases. I think the argument to say maybe going a little bit longer would just naturally be the reinvestment risk that could exist here if we do enter an environment where we do see some, lowering of that Fed funds rate, which I think we all probably a year ago thought we'd be much further along in that lowering of the rates than we are today. So as we look at it now, Vanguard, our assessment is that we're probably going to see about 2 rate cuts between now and the end of the year. That's the number that we have currently. That's an adjustment from where we were just at the beginning of the year. So as you start to see those rate cuts, is that time to go a little bit further out in duration? When we look at something like a 3-month yield, it's really similar to the 10-year now. So is the sweet spot maybe in more the intermediate part of the curve where you don't have the volatility of the long end, but you're still getting good yields? I think an argument could be made for that.
And just curious, by a show of hands, how many people think, I'm going to go give you like 3 options here. How many people think there will be 0 Fed cuts between now and the end of the year? I'm actually in this camp too. How about 1? Okay.
Could I vote against what my firm says? Because I'd go 1.
What, and add a Bitcoin ETF to the brokerage platform? Sure.
Hey, we'll see what happens.
That is so, I can't believe that's just, I'll never get that, but we can't talk about that here. And how about 2 cuts? Yeah, okay. So 1 is pretty much, I think, the 50% and over. It's going to be interesting. I want to talk a little bit about.
Well, how many people think there's going to be like 3 or more cuts?
Yeah, I mean, that would be pretty crazy.
That would be the case.
Yeah.
For longer dated fixed income.
That would be yeah. I always say TLT. Anybody trade TLT in here? Besides you, the BlackRock person. That is an ETF for people who like to overthink things. It's like 4D chess. The economy is going to do this. This number says this. The Fed will have to cut. Then this will happen. And it's like that Zach Galifianakis meme with all the numbers going around. And they end up buying TLT, pouring money, and it never goes up. And there's been so much money just sort of lured into that thing and burned. Someday it will probably be the greatest trade ever. I guess when the Fed cuts 3 times in a row or something. But let's talk about the crisis, the tariff tantrum that happened March, April. The markets were pretty wild. Volume was up. I want to start with you, Ray, because you're a liquidity expert. We have been hearing for years in this ETF space that bond ETFs were a liquidity mismatch and were eventually going to be a problem. And they've seemed to survive every crisis pretty well. What did you see? I didn't see really any issues. I looked all over. Volume was up, which is good, means people are trading them. The arbitrage bands were pretty tight. I don't know. Was there anything to write home about?
Sure. Hello? 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 Okay, there you go. 2 questions. First, how many people in here consider the International Court of Trade when any of this stuff was going on? Show of hands. The International Court of Trade, I loved it when they came out with that. Second, the first term that Trump had, the tariff thing was out, in the open. It was there. People considered it. He certainly campaigned on the idea of evening the playing field. I wasn't impressed when the trade deal was done with the UK, the one country in the top 11 we were actually running a surplus with. But it seemed to appease the markets for a little bit. And then popped up the acronym of the taco trade, which I'm not going to get into here. I'm not getting into taco trade here. But at the end of the day, I think the market has calmed enough sufficiently. There was the Trump 2 term. We came out. There was a significant amount of volatility right out of the gate, and then it was tough to fathom that we come off that much. I thought it was an overshoot at the beginning. I thought we hit a little bit lower on that overshoot before we recovered. But the market's normalized. And then if you look at past, after that, subsequent, at least releases from the Trump administration, I think you see that modified trade after that and a quicker recovery. So I think the markets have almost normalized this. They've become a little bit immunized to these White House releases, and we haven't had them the prior 4 years. And I think we're a little bit used to them now.
And Brian, you're obviously, PGIM has ETFs. What did you see?
Yeah, I mean, I would say we were very happy to see that bonds sort of acted how we thought bonds should, right? And we're talking about, really being on the front of the curve is one of the things Dave is mentioning. I think we would be more an advocate for diversifying across the yield curve. Something like being short term, think like, half a year and in, maybe something like, 2 years, more shorter term, and then something more ag like at around 6. And if you diversify across those 3, historically, you've done very, very well. You're able to really capture the yield that basically you can get out of the ag, and you can get the total return that you can get from the ag, but at the same time, cut your volatility basically in half. And the whole idea of yes, we think the front of the curve, there's much less risk. However, if you wait for the Fed to start cutting, it's simply too late. And so we think that diversifying across the curve in advance is likely the best way to go. And if we think about how that portfolio did, we're very happy to see how it performed relative to, risk assets.
And Joe, you want to get in? You want to get in on this? I know you look at this stuff all the time.
Well, I mean, whenever I work with clients, that's what my role is, right? So as a client portfolio manager, you're always working with, investors, advisors, allocators. My firm has a view, and we do like the front end of the curve more. We think there's risk at the long end of the curve, no question about that. However, whenever I work with a client, I want to know how they think about fixed income, just as a starting point, and then their risk models. And so in my view, given my experience working with clients over several cycles, the way you get in trouble as an investor or an allocator is to deviate wide outside of, let's say, your risk model. Like whatever that objective is, sure, you get paid to, lean where you think. That's why your clients are paying you. But to completely recreate the fixed income model just because you have a feeling, I don't think is ever a good idea. In fact, I would venture to say more advisors have been fired for that alone. So based on what my firm thinks, based on what your risk model is, sure, you could lean in. So if it's a 60-40, yeah, you don't need 6 years of duration. You could probably get away with 5.5, but that's how I would answer that.
All right. Well, we don't really touch too much on the liquidity, but let's just say I'd say ETFs got an A+ during this latest crisis. That's why the article, you don't see them anymore. There's no more hedge fund manager says ETFs are going to blow up the world. It's gone. No more FT fear mongering out there. But anyway, I want to talk about the ag. Look, the ag tracks a Bloomberg index, so I'm allowed to be mean to it. Okay. So I think it is bad. I think it's awful. It's really, the metaphor I use is, these active bond managers, they're benchmarked against the ag. It's like the Harlem Globetrotters play that team, the Washington Generals. To me, that's the ag. It's almost like a team that you play just to beat up on, to make a show of it. And these managers, all they do is add a little credit risk or a little international or a little duration. Bam. It's very easy to outperform it. BND and AGG are like, they rule the bond world. In the last 10 years, they haven't kept up with inflation. And in 2022, they were both down 12% when the stocks were down 18%. So I don't understand why people keep buying these. It doesn't make sense on any level. Can you explain that?
So this is the part I was waiting for, defending the ag. So you said
I'm trying to keep it interesting.
You said
okay?
a lot of
fighting
hurtful things there too,
coma.
Eric, about the ag for sure. But I think when you look at the ag, I think it's a little bit of, I think there's good reason to look in other places. A little bit more universal, a little bit further down the credit spectrum. All of that certainly makes sense. The ag is, the first index that was ever a fund was based off of in the fixed income world, less than 40 years ago. And the market has changed. I think the one big aspect of the ag that still kind of exists to a certain extent is just the liquidity profile that exists within the ag is really strong when you look at, what's there. I think, the improvements we've seen in the fixed income market structure, especially over the last 10 years, and I would attribute the ETF to a lot of that advancement in the fixed income market structure, with the ability to do custom baskets, to negotiate inventory, portfolio trading, the rise of platforms. All of those, I can make an argument, has a direct line back to the ETF. And I think that has improved, some of the other parts of the market to a point where you could have a little bit more confidence going down that credit spectrum, and look at that. But I think for a lot of people, it's just what they're accustomed to, frankly. I mean, maybe it's a bit audacious for us to call it the total bond ETF when it represents 51% of the bond market. But, that's, an argument maybe that I'm making against myself here. So I should probably not say that. But, I think that it's kind of like people still quote the Dow Jones index on the news, and it's the worst way to judge the performance of the market, right? I think that there is some commonality that still shows all that activity that goes that way. And, one of the really important metrics that we talk about a lot on the desk is premium and discount volatility. And when you look at, BND, AGG, some of the other ag funds in the market, they have a really low premium discount volatility, 3.5 basis points over the last year. So for some people, just the comfort of knowing what you're going to get, really good tracking error, really low premium and discount volatility, I think is an allure for some model portfolios.
If I could jump in real quick, one thing that I feel like wasn't mentioned is just the interest rate sensitivity of the ag. And so we're going through a period of the last, call it 25 years. We've seen an increased prevalence of just more treasuries, more non-agency or more agency mortgages, and yields are coming down. All of that together means there's a lot more duration in the ag. So thinking about in the 90s into GFC, the duration on the ag was 4 to 4.5. Now we're more like 6 to 6.5. And we're living in a world with really high realized volatility anywhere on the curve. You can look at the 2-year, 10-year, 30-year, just look at treasuries, what the actual realized volatility is, and we're at 20 years highs. So you've got an increased sort of just volatility and an increased magnitude. And that for us just spells basically disaster. Again, why we would say diversifying across the curve would be beneficial.
Yeah, there's again, not to be nice to BlackRock again, but they have this ETF IUSB, which tracks the universal. That has a little high yield and a little international. If you replace the ag with that, bond managers' beat rate goes from like 67% to 33% like stocks. It's just a more fair benchmark because they go into credit. And you guys don't have a universal. That's also a Bloomberg index, but we'd be happy to talk to you about it.
Yeah, not yet. Stay tuned. But I think, but when you look at that over the last 5 years, the universals outperformed the ag by 30 basis points annualized, which is positive. But it's, if you have, maybe worse tracking there, which could be IUSB tracks really well, but you could have that experience of people building out that fund. You have the premium discount volatility. There are certain things that would take, away from that 30 basis points as well when you look across the two.
Speaking of alternatives out there for bond exposure, another trivia question here for ETF nerds, and this is not, BlackRock won't be at an advantage this time. In the last 2 years, if you take all the bond ETFs and you sort by flows, what's the one ticker in the top 5 that isn't BlackRock or Vanguard? Yeah. That's right. Good job. Official ETF nerd back there. JA is a shock blockbuster hit. It is hard. It's like, remember DXJ from Wisdom Tree? It's hard to be not BlackRock and Vanguard and come out with a hit that big. And JA really, I think, set the whole industry on fire. It developed a category. PGIM, you guys have a CLO ETF. If you look at the numbers on this thing, they blow you away. It's like no correlation, so zero correlation. The volatility is less than the ag. The returns are good, so the Sharpe is through the roof. If I showed you these numbers without telling you what it was, you'd say that's the greatest hedge fund that was ever built. And I think that's part of why it's caught fire. So I do think that's another alternative. Can you use that in place of the ag and the 40?
Absolutely. I would say it's not going to replace the ag and the 40, but it's a complement to it. Like you said, I mean, we're doing a great job selling it here. It's the volatility in AAA CLOs is really, really low. And it's not just less than the ag, it's less than half of the ag. You look at AAA CLOs back to when JP Morgan launched indices in 2011 and look to today, it's less than half the volatility of the ag. And if you even look at like people trading this thing intraday, if you look at every single trading day over that period, you've had positive returns in AAA CLOs 93% of the time. The ag is like 50% of the time. Even something like 1 to 3 treasuries, 1 to 3 month T-bills, you're only like 75% of the time. So it's a really, to your point, the volatility is really low. These things, the correlation is extraordinarily low, but not to, I've got the mic in my hand so I can take a shot at Janus. The one thing I would say is that Janus, yes, they have a great product. I would say we have a great business. So Janus is really only managing, call it this, 20 to 25 billion in CLOs across these 2 ETFs that they have. We put CLOs everywhere. We put them in our total return bond fund. We put them in our other multi-sectors, and we've launched them as a standalone. So our fund is now, north of 3 billion, received a tremendous amount of flows. And again, I think that we have sort of the execution backbone that really is second to none. And if I think about kind of the CLO universe as a whole, it's sort of a stool with sort of 3 legs to it. You've got the leverage finance aspect because, you've got underlying bank loans below those. So we have one of the biggest leverage finance teams in the world. You think about CLO issuance. So PGIM is also a top 10 CLO issuer. So we know these things inside and out from the underlying to the actual launch of the CLOs. And then, oh, by the way, we're one of the biggest investors in CLOs as well. So a space that we know really well. But I mean, the asset class has been an absolute home run.
Anybody have anything to say, to push back against that?
Yeah, I'm going to have to push back.
Okay,
on
go
that.
ahead. Go ahead. That's what we're here for.
That's exactly what I'm talking about. You take if you've defined the fixed income piece of your allocation, it's going to provide an offset to equity volatility in a recessionary equity drawdown. And so keep in mind, you're talking about an interest rate sensitive intermediate strategy with the ag or an actively managed core type strategy, and you plug in a floating rate credit fund that does not act like that, that's how you get fired. So I'm not suggesting it's not a good strategy. I'm suggesting it's been the right environment, and it is absolutely not a replacement for the ag.
No, completely agree. And just to be clear, I think it's a complement to the ag, something on the order of, put 10% of that in with the ag, and you get a much more efficient portfolio.
It's funny you've brought how to get fired. We have this phrase, CREAM, career risk rules everything around me. You ever heard of that for advisors? Because we look at the flows and we're like, again, we try to figure out what determines flows. And one of those things is advisors is career risk. And that's why I think they gravitate towards the big two. That's why they gravitate towards the 60-40. They don't want to go outside of the lines. That's why, the Bitcoin and some of this new stuff is it'll take a while because they don't want to be like the first one. I think it's interesting. Can you go to triple B? Because now there's triple B CLOs. Where does it end where there could be it's not appropriate to put it into the ETF structure?
Yeah. So once you get down into the triple B and even below, you're getting into equity-like risk. And so it's technically a fixed income asset class. But I mean, if you look at the high yield space, these things yield 15% or more in those CLOs. You're really getting equity-like risk. And that's where things get really dangerous. We, again, are just in the AAA tranche. So really the highest credit quality. Have never seen a default in this entire space in 30 years that CLOs have been around. So really a safe space. And I would not advocate for going lower in credit quality.
And Vanguard, you got any plans for a CLO ETF?
I wouldn't count on that one, no.
It's not vanilla.
I mean, putting CLOs in portfolios as we're expanding more into active for all the reasons that, that Brian mentioned, I think it's an important part of the overall, fixed income landscape. And we want to deliver that total market to the client. So I think we'll see expansion there, but a VAAA, probably unlikely.
They just filed for a Vanguard EMX China ETF, which is pretty spicy for them. So stay tuned. Okay. So,
no comment.
Ray, do you dabble in the CLOs at all?
I don't. We were involved in the CLO space at their inception and prior to the financial crisis, and not after that.
Okay. Ray, being the liquidity master you are, let's talk about portfolio trades. This is where you can hand in a bunch of bonds for the ETF. And there's been this sort of, it's a generalization, but the bond ETF is the ETF is the new bond dealer, where people are really using the large holdings of the ETFs to do a bunch of creative things and the creation redemption process. Do you see that? Is that picking up?
I do. I think they're getting smarter in that regard too, as far as the ramp up. In the emerging market space, you have to deal with multiple time zones, multiple currencies, multiple political risks, and so forth. At the beginning, there were people, for example, coming in to rebalance portfolios that had Central and Eastern European exposure in it, and they'd come at 3:00 in the afternoon on a Thursday in New York. And I think they've gotten a lot smarter in that regard. I think the liquidity overall, even for kind of the super high beta stuff, we trade everything from Lebanon to Ukraine to still some Russia assets, Argentina, Ecuador. And so I think you benefit in large degree by a smarter, at least rebalance and inception task, in that they seem to sectionalize the stuff now. And if they're onboarding something into sovereigns, they'll send out a broad inquiry on sovereigns, corporates, currencies. They seem to be segmenting this pretty wisely now and not having people spend a lot of time fishing around. It's much more efficient.
Do you think that bond ETFs filled the gap in demand to trade bonds like stocks? There was never a true exchange for bonds. So the ETF comes along and now you can trade it just like Microsoft shares. Not
yet, to a degree. As an example, before I came here, there was an election in Korea, and the first headline I saw entering into this yesterday at the start of the day was, massive ETF inflows into the Korean space. And prior to that, it would be commenting on, the stock exchanges, the bond yields, and so forth. Now, the lead is what the implications are for equity ETFs in the space. So I think it's certainly gobbled up a lot of the, the narrative in these events going in. you can imagine the events that I have to deal with, given, Russia, Gaza, Lebanon, all the stuff that's going on right now. So I think it's made it a lot easier for people to focus and to execute on a more liquid basis on strategies like that.
And just before we leave your end of the world,
Yeah.
They put out a catastrophe bond ETF this year. And that was the one ETF, it rarely comes along, where they couldn't find a lead market maker because it was pretty out there.
I didn't raise my hand for that.
You didn't? Okay.
No, I didn't. No.
Is that too far? Can you go too far?
No, I think the market has to mature some way, and the markets don't mature unless somebody takes a stab at something like that. So I don't mind it. I don't think it's out of the realm. I mean, it's emerging markets. I mean, I could sit here and go through the litany of things that are absolutely out of the realm, and that's not one of them.
In Vanguard, when you run the numbers on Vanguard's mutual funds and ETFs, it is astounding. I mean, I think they may have more bond assets by twofold than the number two. Like they have so many bonds, right? Sitting on all those bonds, like, what have you noticed about bond liquidity over the years? Are you utilizing all of that inventory for other things? How's things changed in the past 5 years?
Yeah, I would say, it really, when I think about it, there was one trade in our intermediate corporate in January of 2017. And the market maker who helped facilitate that trade, I think, was a little bit of a muse for them to think about portfolio trading. And we'd really start to see that pick up between, us, certainly a lot of the funds in BlackRock, the custom inventory, the way of thinking about that, and putting that portfolio trading, cap on is really similar to thinking about creating a basket for an ETF. It's a very similar concept of getting certain risk attributes and so forth. And so, I think the ETFs were at the beginning of this, some of the genesis of this move. I think the use of platforms, as people understood suitability in creation a little bit better, we're able to go out there and bid on platforms to get bonds. So all of that just naturally we have to use to our advantage, as portfolio managers, because it's there and it's available. If we get cash in to an open-ended fund, likely we're going to use a portfolio trade potentially for a broad market index to get that exposure. Well, if we're getting that as a creation into the ETF, we need to be thoughtful on what we bring in. We want to make sure it tracks well. Even on the active side, we've been really, adamant from a capital market standpoint to ensure that our PMs are ready and thoughtful of doing this in kind because of the benefits that it provides. It really has helped to collapse the bid-ask spreads, the pricing dynamics in bonds, I think, over time. Have we reached a point of equity-like? No, not yet. And I think some of that's purposeful from the bond market. They don't want to be totally equity-like. They don't want necessarily a centralized marketplace with firm quotes, because you do have that ability to negotiate differently as an institution. So I think as long as that exists, it'll be tough to really reach that same level of equity, but I think it's certainly been democratized and the world has changed due to the ETF.
All right, now let's turn to yield generation. That's really, I think that's the title of the panel. It was broad bond discussion, but yield generation. I mean, it's always a question of the old man in the sea. How far out do you go to get that yield, right? So I'll start with you, Joe. Okay, I mean, what is the ag yield right now? 3% or something?
No, it's about 4.5.
Yeah, 4.5. Okay. Okay, so you have 4.5 in the ag, 4.5 short. Yeah, basically everything's 4.5. How much further do you need to go, and should you go, and can you go? If your goal is yield.
If your goal is yield, obviously you could approach it as a sector allocation. But probably the more responsible way, the way we think about it at Neuberger, is more of a flexible strategy, right? Because there's certain risks in the market, right? And you addressed the duration risk, obviously, with the U.S. Ag. Now, there's times this duration works against you, there's times it's your friend. In terms of credit, there's times when you want to be in a CLO type of a product or a floating rate credit strategies. Times when spreads are wide, you want to be in high yield. And so, kind of the way we approach this through our multi-sector platform, we just candidly launched, 2 income generating ETFs, one at the short end of the curve, high quality. It's a short duration income fund, NBSD, if I'm allowed to say that. And then, more out on the curve, but not too much out on the curve, but more global credit spread products, a Neuberger Flex Credit, so NBFC. And so those are 2 different risk profiles. And that's kind of, you take our multi-sector platform, which is really aren't, we have a relative value investment process. And so that's kind of those are our flagship strategies. And we think the most appropriate, responsible way to generate income is that multi-sector approach, because there's times when, you don't want certain exposures and you want to overweight other exposures. So, more of a global, flexible type of a strategy is how we think is the most appropriate. And sometimes that does mean duration.
And what is that yield?
So our flex credit strategy yields in line with the high yield index, so in the range of 7.5. However, you're taking risk like the high yield market, right? So we seek to enhance the return profile, which means higher Sharpe ratio, less vol, higher Sharpe ratio. The short duration income, it's a high level of efficient income at the front of the curve. So that's investment grade, right? We can go up to 20% below investment grade. And that also yields around 5.25, which with a much, much different risk profile.
Anyone else want to weigh in on this in terms of how far out to go? Where's the sweet spot between high yield and, not too much risk?
I mean, right now, I would say a little bit hesitant to take on risk. Spreads are extraordinarily tight. It just doesn't seem like the juice is worth the squeeze there. So again, I would say from a multi-sector perspective, we would advocate for sort of high quality structured product that gives you that yield enhancement. I mean, you can be AAA rated and still pick up 140 or 150 on top of treasuries, still staying AAA rated. That makes a lot of sense. From a duration perspective, like I said, I feel like a balanced approach is most appropriate right now. There's a lot of risk on the back end. I mean, one of the things people have asked me before is, should I just buy TLT and just hang on for 10 years? And it's like, if you're okay with having, months that you could be down for 10%, I mean, that's something that has historically happened. So you have to understand that your clients are going to get a quarterly statement and you have to be okay with them being down north of 10%. And so it's a really volatile trade. And I would say not advocating for that, but really advocating for more of a balanced approach.
So you guys selling fixed income ETFs, then you got these equity guys over here. They're coming out with the options overlay. So they're generating yield using options, right? So you've got the tamer version like JEPI, which by the way is the #1 biggest active ETF in the world by a good margin, JEPI, because it yields like 10%, 11%. They're going out, and so are the buffer people. The first buffer ETF is the ticker BALT, Bond Alternative. They're going out and they're saying, yeah, these bonds, they don't work anymore. Look at 2022. You don't even get that much yield anymore. I mean, 4% is not bad for treasuries, but we're going to give you 10% and we'll give it if there's a sell-off, this won't go down as bad as stocks. It seems like these options overlays are competing with the bond world. Do you find that, or is that just me seeing it in the data and like creating that narrative? Go ahead. PJ.
All right. So the one thing I would say is that yes, there has been a period of like 2022 where people are pointing to that and saying that, stocks and bonds, or basically bonds didn't offset stocks. That's one period. One period doesn't make a trend. People have been using fixed income to offset equity market risk for 100 years. We're talking about one period where this didn't really work. Even if you look to the April, or let's call it the 2025 sell-off that we had, starting with a peak in February and then bottoming out in April. I mean, stocks were down close to 20%. The Mag 7 was down north of 25, and long duration treasuries were up 3%. I mean, that's doing its job if you ask me. Sure, there's short-term pockets where things don't necessarily work out, but if you take a longer-term view, this idea of using fixed income to offset equity market risk, I feel like that is still a thesis that's still very well intact and not something we're concerned about.
Yeah, I would maybe say like, we look at something like JEPI, 2022 is the highlight, right? That year, what it did that year relative to the rest. But when you look at total returns for 23 and 24 and even into 25, you're actually getting, better returns from an S&P 500 because you don't have a capped upside. So in a bull market, that premium income, it's seductive when you look at the yield number, but like, what are you really giving up to be able to get that yield? I think is an important thing for clients to think about. And for some clients, it still might make sense. If you're on a fixed income, maybe you just like to get that yield. It looks good for certain advisors that are pushing for that story. But, I think it's important to, take a look back. I think, is there an opportunity for buffers to take some of that ballast away that you see in bond funds? Maybe. But as a complete replacement of bonds, I think it's just, to Brian's point, I think it's tough to see. I think we're focusing too much on the third worst year since 1930 in 2022 for the 60-40.
And, there's people going out now, like there was the guy from Fidelity who did a 20-minute. I really, you should look this up. Guy from Fidelity went on with a suit on and spoke to all the corporate CEOs in this C-suite room about why corporations should add Bitcoin to the treasury. And one of the reasons was this idea that inflation eats up almost all the yield. And I think it's another reason that Jeppy and those can make a case. And Bitcoin. So I know I dabble in the crypto world, and a lot of them, they will have some stocks, but they are done with bonds. Paul Tudor Jones even said, I'm done, because all roads lead to inflation. What do you say to that?
What do I say to that?
Anyone?
I mean, I'll take a stab at that. I mean, so if you go back to the 70s into the 80s, that was the period that people point to, right? And, if you run like rolling 12-month returns using the now Bloomberg indices, you're right.
Yeah. No.
And the Treasury index from the inception, which I think was 73 through that 81, 82 period, had negative returns like less than 5% of the time, measured on rolling 12-month periods. Now the ag, which went back I think to 76, it had significantly more. I think it was over 10%. But these are not horrifying returns, and that's assuming, right, that we know the Fed funds rate, peaked in I think August of 81 at like close to 20%. I mean, I don't know. You have to assess the risk for yourself, but those are the facts, right? And so, yes, things are different. Things have changed, but it's. I think that the point is, we've gotten used to fixed income being that negative offset to equity volatility, when that really only existed like through the 90s, the 2000s. It wasn't the case in the 70s and 80s, right? Yet people found a place for it in the portfolios. We just have to change your view of the world, the period that we're heading into. What are the risks? And the truth of the matter is, fixed income gives a different return sequence, which means it will still benefit your allocations. You just have to think about it differently. But that is a period that we did have inflation, and the results were hardly horrifying.
All right. So we got 12 minutes left. I wanted to open it up for any questions. I have go ahead. In the back there, gentlemen.
Thank you for today. It's been great. I'm just curious. Can you, this to the panel, this is to our great moderator. Many advisors will not go into a bond ETF simply because the institutional involvement in the market is still dominant. And they can find a lot more value with a portfolio manager and an open-ended mutual fund, getting really great deals even before it even hits the market. So, and because of that better yield, maybe you can argue better quality. So I'm just wondering, can you give us a good counter argument to why someone would do a bond ETF versus, setting up with a portfolio manager, great track record, open-ended bond fund?
So, I think when we look at the comparison between mutual funds and ETFs, we hope that our ETF managers are also really good portfolio managers too, who are really thoughtful on their allocations and the way they're going to approach it. If it's, it's a little bit different story between the passive and active, but on each of them, there are some advantages the ETF provides as far as transaction costs, in my belief. And, some of that is just the two layers of liquidity that inherently exists within the ETF, that only about 15 to 20% of any ETF volume is usually going to end up even in the primary market. And when that happens, the portfolio manager has full control over what they bring into that portfolio and is able to use similar decisions, as I had mentioned earlier, as to getting cash flow and putting that to work within the portfolio. So, I think that you can get a little bit of the best of both worlds there, where you get this opportunity to, have this, the flow coming in through that is accessed by market makers who have different dynamics, that might be buying closer to the bid, delivering bonds in, and therefore can sell the ETF cheaper. And that's even after they, choose to actually create or redeem it at that point. So I think, just the two layers of liquidity, that ability to buffer some of that liquidity in the market is certainly helpful for lowering that transaction costs. I think 20 years ago, the idea that you could put $500 million to work in long-term corporates at a 15 basis point, spread above the bids of those bonds was unheard of. And that's now available in the ETF marketplace. So I think that, there are some advantages, naturally within the ETF.
The one thing I would add is this idea of giving up a good quality manager by going into an ETF. That's not necessarily something you have to do either. Speaking specifically just across actively managed fixed income, I know for us at PGIM, we've got similar portfolios both in mutual fund flavor as well as in ETF vehicles. The portfolio management teams are the same. The constraints are the same, and really it's the same process. So it's kind of pick your vehicle and giving investors that optionality.
I want to add here also, it depends on what share class you can get into, right? So when Bill Gross launched the PIMCO Total Return ETF, he priced it between the I class and then the retail classes. So if you're in the retail class, you kind of got screwed because this new thing was cheaper. The I class, it was fine. You were already cheaper than the ETF. But nowadays, like JP Morgan in particular, started pricing at the I class or the R6 class, which is the cheapest mutual fund class. So a lot of times, like a lot of the money goes to like low cost active ETFs. PIMCO though has this income fund that's 1.05% or something. And I believe that's the institutional pricing, and it still does pretty well. Active bond mutual funds have held up better against the passive thing, way better than stock pickers. And I think it's from what you're saying. There's good managers. Some of the bond funds are legit good. They're beyond my easy to beat ag story. They're actually really intelligent. If you talk to them, you can see how smart they are. But more and more, you can get them at the I class. Just saying. But if you can get the I class of a mutual fund, that's pretty good. I mean, right? Would you agree with that? Like, it depends on the class too. An A class mutual fund though, I would almost I don't think I would ever recommend anybody buying an A class, right? It's too much, especially for the amount of little money you're putting in. It eats up so much of it.
Yeah, but I think, one of the things that, we're obviously known as an index manager, but we have a really large active franchise, over $1 trillion in fixed income when you include money markets. And, I think when we look across, those two, what we've always said is that we're not against active, we're just against high cost active. It's tougher to actually deliver that alpha target if you do charge too much. So we think by bringing the expenses down and being able to keep the costs low, even for active, that allows the managers a little bit better opportunity to be thoughtful on what risks they take to be able to produce that yield or total return. And the ETF has brought that down for everyone. It's, some of it's the Vanguard effect or the Bogle effect, as some people have written about in this room.
Thanks for the plug.
But, some of it is just the nature of the ETF is cheaper to manage for a lot of the reasons that we talked about. And that helps bring that down and create better return profiles for clients.
My buddy at Morningstar put it this way: ETFs externalize costs, mutual funds internalize them. So it's just a more cumbersome, costly structure. Whereas ETFs, like, you pay your trading fee, you pay your own way. People inside it don't have to pay for other people trafficking in and out of it, which is so annoying, both on the fees and the taxation side of it. So I think that's also another thing to consider. All right, anybody else?
Well, just
Sorry,
to
go ahead.
add
Who wants to
that
jump
one
in?
point on, and I know this is an ETF conference, and don't want to step on anyone's toes. But the fixed income markets have evolved. I mean, as the infrastructure in the ETF market has evolved, the structure is more conducive to certain types of illiquid securities that was always available to an active mutual fund manager because of the structure. So that's changing, and it'll likely continue to change and evolve. But I mean, so from this point, looking backwards, I think mutual funds generally had an advantage over actively managed ETFs, which is why you have not seen a proliferation of active fixed income ETFs. You're starting to see it now. The game is not late. I mean, if an active manager, traditional active manager, hasn't been in the ETF space, we could safely assume they're late, but not necessarily in fixed income.
Yeah, I would agree. You have to look at those two asset classes a little differently. I think bond managers have just been held up better. We'll put it that way. Anybody else? If not, I do have another one to pivot to that's related, but I would rather, this gentleman over here.
Sorry, Eric, I didn't know where you're going with this, but just back on the ag topic for a second. So you could probably argue for more than 5 minutes about index construction and the market, right? Is the index reflective of the market now? But just kind of in short, like, is the ag just crowded? Whether it be just index exposure or the index hugging that goes on. I mean, is it just a crowded index?
That's a really good point, because you're right that the active has to stay close to it too. Same people say the same thing about the S&P. It's not just the passive money; it's the index hugging money that creates this just large pool of demand. But maybe that is part of it. It's just a little crowded, and you get better deals if you go swim again away from these crowded waters.
I mean, I think, so I want to make sure I understand this. So you're talking about the active managers within the U.S. ag space. Is that
He's saying the reason he's saying the yeah.
Well, it's a market weighted index, right? So it's crowded to the extent that the government issues too much debt, right? So we've had, the treasury market, I believe you go back to December of 2007, it was like 23%, the treasury component. It's twice that now. So if you view interest rate risk as your primary risk, you would say, okay, I want that risk profile, but that's why I'm going with an active manager, right? So you could have a 22% weighting to treasuries today, for example, and you're way out of benchmark weight, right? You're half the benchmark, but you're the same weight as you were in 2007. So depending upon how you think about tracking error, which is really how that market, that looks at it, if you have a wider band for your tracking error, that may be appropriate.
Yeah, I would agree with that. Anybody else? Yeah, in the front. Yeah, so the question, I'll just repeat it, no worries. Money market ETFs, which they do not have a fixed NAV. So, they're not quite there, but they're throwing the label money market on an ETF. They haven't sold that well. The money still goes to the old school ones that are like just called short-term, ultra short-term treasury. I mean, is there anything here? I see this as more gimmicky, to be honest. Am I wrong?
I mean, I think the challenge is the lack of stable value, right? I think the clients that do want to have that and just be set with some, no capital depreciation, no appreciation, you get that trade-off for the yield that it produces. I think, there's opportunities where if you don't trade it right, you could trade it at a premium. You could have market impact. You got to be really thoughtful. And, anybody's high touch desk will try to protect the client from that. But we've seen too many trades, from our seat of people that just, drop the market order in on a book and rip through the book. If you do that in a money market fund, you're never going to get that back. Right. So I think, I just don't know exactly what it solves. I think it's the tough part as we kind of looked at it ourselves and we're curious. I just, you end up with, you can usually take large sizes, institutional sizes in the funds. That's one of the perks of ETFs is that you don't have any limit qualified or large transactions with the portfolio manager. So I'm just not sure. I think that lack of stability in the price is pretty damning for the portfolios.
Yeah, I think it was just an attempt to see if a new label worked. JEPI, I mean, it's a covered call strategy, but they called it equity premium income, which is like the tuxedo Winnie the Pooh version of covered call. And it started flying off the shelves. I'm telling you, sometimes they just tweak the words a little, and all of a sudden it makes sense in the investor's brain. So I get why they tried it, but I think most investors are just fine with the ultra short treasury.
And it probably doesn't get a fair shot too with like Schwab and some of the other custodians not allowing it on the platform too. I don't think we're really getting a sense on like what the interest would be from the advisor community in full, but I think it's a tough spot.
Okay, I just want to end real quick because I got to get your take on this. Is the private credit ETF? Priv came out, didn't really do much. Now they're doing an ultra short term one. There's now pushing to get private equity, but let's stick to credit here. You get a little more yield for the same, quality, I guess you could call it. But do you see this space blowing up? Not in a good way, like getting assets, or in a bad way, or like this. We thought it would be a little bigger with Apollo involved. Anyone have any thoughts on this sort of at least early flopped private credit thing?
So maybe I'll start. I think the challenge we've heard from some clients who've looked at it is they're just struggling. You can get for better or for the worse, the ag funds are 3 basis points, right? Where there's a 70 basis point charge to be able to get into private credit. And you're only getting exposure to around 15-20%. I think that premium that you're paying to get into a limited number of private is turning some clients off. I think it's a great first step to try to democratize private credit. So I give, Spider a lot of credit for giving it a good shot here. If the clients don't come in, it doesn't really matter. So I think it's going to be interesting if that evolves. I think you just need an involvement in the private credit markets and the trading of private credit, and that can come from ETFs. We've seen a bunch of other parts of the market improve due to the ETFs. I just don't think we're there yet. I don't know if anybody else.
No, I mean, I just think given the growth of the private credit market, which, to be clear, is now bigger than the publicly traded high yield market and publicly traded loan market, and that's happened in 15 years. I would expect some growing pains. I'm not saying it doesn't have a bright future. So you take an illiquid security that has really emerged over the last 15 years and you stick it in a liquid wrapper, I could see some problems. Right? That's just my opinion.
Well, one pushback, HYD, the Van Eck High Yield Muni, this thing has, in 2020, this thing was frozen. None of the bonds were traded at a 29% discount. It's still traded. That's the good thing about ETFs. They will trade. You may not like the price, but it will trade. Since then, the thing's taken in $1 billion. The volume is bigger. Nobody cares. I think people are okay with premiums and discounts. And Egypt was an ETF where the stock market there was closed for 6 weeks, and the ETF traded on. It had a premium, and then it collapsed when it came back. So I'm just going to end on my thought, I guess. Sorry. I just want to throw out HID is a good counter to that. But anyway, thank you very much, panelists, for a great job.